Hello, everyone. I'm Todd Rosenbluth, head of ETF and mutual fund research at CFRA, and I'm excited you've joined us for a fundamental approach to seasonally strong defensive sectors. We're going to specifically talk about not only the sectors, but ETFs that you can use to gain exposure to that. As we move to the next slide here, just to show you who else is joining me for the presentation, those of you from that know of CFRA are familiar with Sam Stovall. He's our chief investment strategist. We're joined by Steve DeRoyan. Steve is the head of ETF products for John Hancock Investment Management. And Steve is a longtime industry colleague. We know each other for a long time. I'm excited for him to tell you more about the John Hancock suite coming up. As we move to the next slide here, just to tell you more about the way that our ETF research and our sector research fit well together. What you're seeing on the left is a stack going from market commentary and sector research that Sam, our chief investment strategist, leads, down to the ETF research that I head up, to our company research, which is individual stock recommendations, qualitatively and quantitatively, that helps to power our ETF research, and that you're probably quite familiar with from a buy, hold, and sell recommendation using the 5-star system. We also combine fundamental research with forensic accounting research to get a better understanding of the earnings quality of the companies, both from a risk-on and risk-off perspective. As we move to the next slide, you'll see how this fits together with our ETF research, and that we do so independently. We are just purely a research company. We don't manage any money. We don't have an asset management arm. The recommendations that we'll talk about on this presentation and that you can find on Market Scope Advisor are truly our own. We do not have any insights as to where that ratings are going to go. It's quantitatively and it's independent, and you can have confidence that when we talk about it, we have the confidence for these ETFs going forward. Let's move to the next slide here, just to show you how our research is done from an ETF perspective. We're combining, as mentioned, forensic and fundamental accounting and fundamental research to be able to understand what is inside an ETF. This is a more forward-looking approach than others within the industry are doing, because we are trying to figure out the probability of success of that ETF going up or down versus the broader category. We're leveraging our team of equity and accounting analysts to offer that forward-looking view, and then combining it with additional metrics tied to cost and tied to the fund specifically. And lastly, as we move to the next slide here, just to show you what drives the overall rating, we look at it from a cost, a reward, and risk perspective. And when you see a report from CFRA, the higher the score, the more it contributes favorably to that rating. So in the case of cost, a score of 75, as we show on the screen here, would be least expensive. A risk score of 56 would be relatively safe. And that 69 in the middle is just the reward potential of the underlying holdings. Specific to ETFs, you can see on the right-hand side, we are rating ETFs versus a broad universe. So we're going to spend a lot of time talking about sectors today. There is a separate U.S. sector covered universe. We split that out from U.S. diversified equity ETFs. So an ETF that has healthcare and consumer staples and technology together is going to be viewed separately than one that is just solely dedicated towards that. And then we separately rate global equity ETFs and fixed income ETFs. Before I move forward to the next slide to bring Sam Stovall in, I want to encourage you to ask questions now and throughout the presentation, and we'll get to as many questions as time permits. Let's move to the next slide here, Sam, and I think this is where I bring you into the conversation to talk about the investment strategy and the sector rotation approach. Thanks, Sam.
Thank you, Todd. Thanks, everybody, for tuning in. Happy to be here. I am going to be talking about playing defensively, a sector rotation discussion. If we take a look at the next slide, my topics of discussion are, first off, recessions, followed by market declines, and then lastly, what you can do about it, the typical sector rotation that we see within an economic cycle, and then what we see going forward. Sticking with this slide, recessions, there's the old saying that bull markets don't die of old age, they die of fright. And what they're most afraid of is recession. And so frequently I have people asking me, Sam, let me know when we fall into recession, because then I'll make some adjustments to stocks. Well, unfortunately, recessions end up being a lagging indicator. So I am going to go through the 12 economic recessions, what their magnitude and durations were, sort of to prep you for the fact that in terms of market declines, the stock market anticipates recessions by as much as 8 months on average. The markets have fallen 27% associated with these recessions since World War II. And the market has traditionally bottomed about 5 months before the recession ends. So what can we do about it? Well, certainly by understanding when sectors have their day in the sun during average economic periods since World War II, and then also realizing that, while we could have longer term bull and bear market moves, annually we tend to have rotation between cyclical sectors and between the defensive sectors. So let's take a look at the next slide, which shows the 12 recessions going back to World War II. The longest was the one that we most recently went through back 2007 through 09, 18 months, the shortest being in 1980. Some economists, however, say that you really should combine the 1980 and 81 recessions, so that might end up being the longest since World War II. So we've had 12 of them. If we take a look at the next slide, we will see that the market did end up going through some sort of movement during these recessions since World War II. Obviously, GDP saw a decline in each one of these recessions, but if you were to look at the recession itself and exclusively show the price performance of the S&P whenever the recession started and ended, amazingly, you would find that the market rose an average of 1.3% and was higher 6 times and was lower 6 times. So I'm sure investors are scratching their heads thinking, well, wait a minute, don't we want to try to anticipate what happens? Well, that is the $64,000 question, as can be seen in the next slide. What I have found is that, again, we have those 12 bear markets, but then I have aligned market declines anywhere from as little as 7% up to as much as 57% anticipated these recessions since World War II. The two right-hand columns show that the market peaked anywhere from 7.7 months to 13 months to 12 months, et cetera, but averaged 7.7 months ahead of the beginning of the recession. And it ended up bottoming about 5 months before the recession was over. So the market ends up being a good anticipatory mechanism. So really, you should be trying to anticipate what is going to happen with the economy based on what the stock market is doing, not trying to guess what the economy is doing and what the market will likely do next. So put the market ahead of the economy. If you take a look at the next slide, what we typically find, and this is 2 books that I wrote back in the 1990s, tying stock market movements to phases of the economy. And you can see in the top right quadrant, healthcare and consumer staples tend to be the better performers in the early contractionary phase of the economic cycle. Usually it's because the Fed has been raising rates aggressively, which has thrown the market into a tailspin and eventually through the economy into recession. Once the higher rates have run their course, then utilities, financials start to do better, and then we see the cycle starting all over again, moving back into the cyclical sectors. So in the next slide, we'll see, well, what happened this time around from February 19th through March 23rd? Not surprisingly, consumer staples and healthcare on a relative basis were the best performing groups. I like to say jokingly that when the going gets tough, the tough go eating, smoking, and drinking, and if they overdo it, they have to go to the doctor, which lines up on the right-hand side with the average sector performances during bear markets since World War II. Again, healthcare and consumer staples posted the lowest declines, or I should say the shallowest declines relative to the market, and also a batting average 85% of the time whenever we did have bear markets, healthcare and staples outperformed the market as a whole. Another area that tended to do well was utilities historically, but this time around, it ended up falling more than the market, primarily because prior to this, investors who typically were bond investors looking for yield gravitated toward utilities to serve as bond proxies. And once the market did end up declining, they ended up bailing out because they couldn't stand all of that volatility. So the next slide will actually show us that within an average calendar year, we do end up having periods of strength and weakness. We've heard from the Stock Traders Almanac that the weakest 6 months of the year are May through October. An old market adage is sell in May and go away, because the weakest return up 1.4% versus the strongest up 6.6% November through April. However, I'm a big believer that you are better off rotating than you are retreating, because 1.4% is better than you would get in cash, and the market tends to rise a little more than 6 out of every 10 years in this May through October period. If we take a look at the next slide, we also see that information technology, healthcare, consumer staples have been among the better performers within the S&P 1500. That's the large cap plus mid cap plus small cap indexes. Since 1995, those three sectors have posted the strongest price gains in the May through October period, whereas energy, real estate, and materials posted the weakest returns. Last slide says, well, gee, could you actually use the word recession to serve as a market timing indicator? If we go to that next slide, we see using recession as a market timing indicator. The S&P, as I mentioned, peaked about an average of 8 months before recessions got started. The National Bureau of Economic Research, they're the ones that tell us when we fell into recession, but they usually tell us about 8 months after the fact. Isn't it interesting, though, that bear market 14 months from peak to trough? So recession uttered by the NBER, it's probably time to be buying back into stocks in general, because again, the market anticipates things, and by the time the NBER gets around to calling it a recession, it's time for us to be moving back into stocks. So that is sort of a general primer on what sectors tend to do well, poorly within an average economic cycle, but to learn more about a more intricate way of engaging in sector rotation, I will pass it back to Todd.
Thanks, Sam. Great presentation. We're going to move further along into the presentation, talking specifically about sector-oriented ETFs, some of the fundamental products that John Hancock has, and how they're constructed, and how they're constructed differently from some of the more market cap weighted products that investors and our clients are familiar with. So let's move to the next slide here. Let me bring Steve DeRoyan from John Hancock into the conversation. And Steve, I think this and the next slide gives a good framework for how John Hancock has used index-based strategies to be able to have more of a fundamental approach.
Yeah, thanks, Todd, so much for having me today. It's always a pleasure to speak with you. Sorry we can't be in person. That's always a pleasure as well. So, Todd, you know better than anybody, John Hancock believes that not all the best ideas and talent can sit in one house or one roof and under one roof. So, as you know, since 1988, we've been a manager of managers, and we've employed that model here with our ETFs. So we've gone out about 5 years ago now and selected dimensional fund advisors to sub-advise our ETF suite today. For those of you who are not familiar, which I'm sure there aren't many of you, with dimensional funds, you know that they have a foundation built really on the Farmer and French paper from the 90s. But even before that, their focus was small cap. They were the first manager of small cap funds. And so they've had a really fundamental, or what I would call a factor-based approach in investing from the beginning. And as you see here on this slide, you'll see the, excuse me, the use of size, value, or sometimes referred to as relative price, and profitability as the three main factors that they use in their equity strategies. These factors or premiums have really been cultivated over time because they really fit into these 5 categories to the right. In other words, they are all sensible, they all are persistent in terms of their ability to create excess return, they all have a pervasive approach to them, they're robust, and they're cost effective to implement. And that last piece is not lost, should not be lost in this discussion, because there are other factors, quote unquote, out there that may be academically viable, but when you actually try to implement them, they're not quite as cost effective, and you lose a lot of the benefits. So as we look at the next slide, what we asked Dimensional to do is to actually take a look at how this philosophy could be implemented in more of a sector strategy. Historically, Dimensional has had very broad indices or broad portfolios that capture the entire market, if you will, within the US or emerging markets. But we thought there was an opportunity to get a little bit more prescriptive and opportunistic for our investors. And so what we asked them to do is take a look at how their philosophy of highlighting value, profitability, and small cap would fit in to a sector specific model. So the history tells us that the research is pervasive here as well. Value, high profitable stocks tend to outperform growthy, low profitable stocks. And that's sensibility is right there. You could, when I say those words, I'm sure a lot of people will say, oh, of course they do. But again, history, it's important to look at the numbers and make sure that's the case. So whether you're looking at sectors like staples and industrials where the outperformance is quite wide, or maybe it's more narrow in areas like materials or even financials, even technology, everybody thinks of that as a growth play. Even there, value, high prof stocks outperform. So as we think about this, we said, all right, we think we got something here, and we're going to go ahead and try and implement it into a process that investors can use.
So Steve, and this is a great setup for the next slide here, just talking about how the index is constructed, how the Dimensional Funds pulls this together so that it's weighting the stocks appropriately and it's sorting them based on the highest profitability and the lowest price.
Yeah, let me walk you through that, Todd. It's important to understand when you talk about index investing in general that you understand the index and what you're getting exposure to. And again, this process falls into the smart beta multi-factor world, right? So it's not your typical just run-of-the-mill, hey, the biggest stocks get the biggest exposure. So let's take a little time to walk through that. So whenever you talk about creating a portfolio, or in this case an index, you got to start with the universe that you look at. So we looked at the top 950 stocks within the US. And in fact, our model allows us to go all the way down to 1,000. So it's a pretty wide group of stocks. That's important because it gets us 2 things. One, it gets us the dispersion that we need to be able to segregate out the stocks. And 2, it gets us a much more diverse end product that we think is more appropriate to get exposure to the sectors. So after we look at the big universe, we divide it up and give each stock a score based on the size that it has in terms of market cap. Then we look and divide them into sectors. And then again, we score them on a value versus growth basis and a high profitability versus low profitability. And you can see the numbers here. This is how we get to the tiltings that we want within the portfolio. So if we go to the next slide, let's take an example of what a hypothetical or a theoretical couple of stocks might look like. So company A, company B here. Company A is highlighted by the star, and you notice that that's a larger stock that's on the growthier side and doesn't have great profitability. And then you look at company B, and this is a smaller stock in terms of market cap, a value-oriented stock, and profitability is in the middle, right? So we try to, these are actually, real stocks at some point in time. These are real numbers, if you will, but we can't identify which stocks they are. And it's a historical look, but these are real. So one of the things that's important to understand, if you think of those factors I talked about at the beginning, value, profitability and size, one of the pieces on top was market. And why that's important here is that you'll see we start with the free float market cap weighting for the stock within the proposed portfolio. So the 950 stocks are given a weighting based on their market cap. So we start with that fundamental belief that the starting point should be market cap, and then we tilt the stock in the direction in terms of weighting that we feel will give us the best exposure to the premiums that we want to have, that we think will drive expected return. And so you see company A, as I mentioned, that larger, growthier, low prof stock, it pretty much ends up in the same place that it started in terms of its adjusted free float market cap. This dimensional expected return adjusted free float market cap is how we recalibrate this index. So the weighting hasn't changed on that particular stock, but the end weighting in the index will change because company B is actually getting more weight. And what I mean by that is you'll see the smaller stock has a multiplier of 3. It has a relative price or value multiplier of 1.8 and a profitability multiplier of 1.4. So the adjusted free float market cap actually pushes that market cap up to a theoretical 189 billion. And you'll see at the bottom there on the final part there, the equals area, the company weight in the index is much different. So on company A, if we were just a market cap, this stock would be weighted at 1.83%. The end result is about 70%. And then company B, which was smaller just based on market cap, actually gets value to that, and it goes from 42 basis points to 118 basis points. So you'll see how that kind of holds through and that tilting happens.
So we're going to end up seeing this in a real world scenario when we talk about some of the ETFs and how they're different than the cap weighted versions. But let's just move here to the next slide, because I think this is interesting. People are likely to think that when something is smart beta oriented, there's rebalancing that's taking place, there's perhaps more turnover and more churn. But I find the memory approach that's being used to be quite compelling too, Steve.
Yeah, this is probably one of the most unique elements of what we do here, and it's candidly, it's when people think of dimensional funds, it's an active shot. And what we asked them to do was take their active intelligence and put it into a systematized process. Wasn't overly difficult for the rocket scientists and engineers that work there. They love the challenge, and they were able to do much of that. So we already talked about one of the elements within index memory that we have here, which is this idea that we have the hold range. So a stock that started at, say, number 946 and was included in the index in one quarter, if the next quarter that relative size has dropped the security from 946 to 970, let's say, a sort of traditional market cap weighted index would kick that stock out. That may not be the best idea. Number one, the transaction cost to just remove the stock may not be of value. And number two, the stock may have a lot of the same criteria that we would want to see in terms of profitability and in terms of value. So just simply moving up and down that dotted line there, that baseline, is not enough to push an individual security. That helps to minimize tracking error, which also minimizes cost and transaction cost. So that's a focus for us. The other thing that we do is we do look at momentum. We talked a little bit at the beginning about some factors that many folks feel are academically appropriate but difficult to implement in terms of cost. Momentum falls into that category for us and for dimensional funds. But we do see value. There is definitely something there when it comes to momentum. So the way that we've employed momentum, if there's a security that's in the index that is in this low momentum space, so in this case about a 30%, on the 30% side of low momentum, so the bottom third basically when it comes to momentum, we won't add to that stock. It'll stay in a locked position in terms of the weight. We're not going to sell it because we don't believe it's a sell signal, but we won't add to it. And that, again, decreases cost and helps our turnover quite a bit. The last element of small weight changes, again, if there's a narrow small change in the weight for an index inside the index, we don't necessarily have to implement a 2 or 3 basis point increase from rebalance to rebalance. That additional cost just doesn't always make sense. And the final piece here, enhanced redistribution, we call it. This is a great factor to implement when you have a stock that has been either acquired and there's a big cash situation that's coming into the index fund. Today, if a stock leaves the index, most indices, certainly market cap weighted indices, would just take the money that comes into that index and then pro rata, or peanut butter spread as I like to call it, across all the different stocks that are in there. What we do is we actually do a mini rebalance in the index, and we actually give that additional those additional dollars to the stocks that are least are most underweight, or most underweight to where we would want them to be if we could rebalance the entire portfolio today. So we end up only trading maybe 5-6 stocks in that example, rather than all, in the case of sectors, 50, 60, 70, 120, or in the case of our larger portfolios, 750. So it makes for a very, very efficient process when mergers and acquisitions come into play into the index.
So Steve, I'll move us to the next slide here, which is as much of a setup for me to then talk about the John Hancock ETFs versus some other peers that are market cap weighted. But maybe you can just summarize the key takeaways for the audience about the differences in the dimensional sector approach.
Yeah, I think the focus there on the right-hand side, we're just like other products. We are targeting the sectors, but we're doing it in a fundamental way where we're really trying to isolate those factors that increase expected return. We're looking at diversification as a factor that we think holds true not only in the broad markets, but even at a sector level. And we aim to limit turnover in really increasing the overall value in what the client gets in terms of performance by keeping costs as low as possible when it comes to transactions.
Thanks, Steve. And so to segue between your part of the presentation and Sam's part of the presentation, I'm going to move us to the next slide, and we're going to talk about a couple of the sectors in particular that CFRA likes and that fits in well from a historical perspective. Initially, we're going to talk about consumer staples. The leading ETF is the Consumer Staples Select Sector Spider, XLP. The John Hancock product is shown here on the right-hand side, the John Hancock Multi-Factor Consumer Staples ETF, JHMS. And what folks would see is a lot of the same underlying holdings that you find in the cap-weighted also appearing in the more fundamental multi-factor approach, but the weightings are significantly different. So let's just focus on the John Hancock one. That's easier. No position is larger than 7%, as opposed to 4 stocks that are heavily weighted within XLP. You're going to find Costco wholesale being overweighted within the John Hancock ETF, Kroger being a top 10 holding that you don't find within XLP. But similarly, Procter & Gamble, Pepsi, Coca-Cola, Walmart, the weightings are all considerably smaller. It's more diversified, and again, taking into account the profitability and the value characteristics of those securities. I would highlight that CFRA independently has a 5-star rating on both of these ETFs. We think both of them can make sense within your portfolio, but they are considerably different in their exposure. They're considerably different also in the assets under management. So the underlying holdings are the same. The liquidity of the ETF is driven by the underlying holdings, not the assets under management. And so we think both of these could make sense within someone's portfolio, depending upon if they wanted a cap-weighted approach or a more smart beta fundamental approach to it. Let's move to the next slide and just look at healthcare. The healthcare ETF from John Hancock, again, you're going to see a lot of the same overlaps in names within the portfolio, but the weighting is being considerably smaller. So names like Johnson & Johnson, United Health, Merck, the top 3 are all much smaller positions in JHMH than they are in XLV. And there's a couple of stocks that you'll see rising higher up. Gilead Sciences is a top 10 holding. Gilead Sciences is making news as of late as they are taking the appropriate steps and moving forward with COVID-19 medication. So that's really encouraging that this strategy spotted that from a quality and evaluation perspective. in a quite compelling way. There's some other stocks that you'll see that are much smaller weightings. But again, the diversification at the security level, I think, stands out to us at CFRA. For both these 5-star rated funds, they just happen to have different underlying holdings as well as different cost structures. So you want to make sure that you look at the risk, the reward characteristics of the holdings and the performance record, but also the cost structure. With that, let me move us to the next slide, which is my opportunity again to invite you to ask questions. We've gotten a handful of them, so I'm going to start with those, but I'd encourage folks to continue to submit questions, and again, we'll get to as many as possible. Sam, the first one for you, if I can bring you back in, if you're on mute, to come off of mute, is to just talk about the sector outlooks. I believe consumer staples and healthcare being highlighted in the question are favorable sectors. Maybe you can just touch on why and if there's any other sectors CFRA is favorable on.
Sure, Todd. Well, we actually have overweight recommendations on 3 sectors, on consumer staples, on healthcare, and also on technology. As I showed earlier in my presentation, those sectors tend to be among the better performers, both on an average price change basis, as well as a batting average, a frequency with which they outperform the market in the relatively challenging May through October period. At the same time, we take a look at what do the analysts think in terms of the CFRA STARS system, that is stock appreciation ranking system, or basically what are the buy, hold, and sell recommendations within that underlying sector. And then we also take a look at the scores coming from the ETF research that you head up, because that reward ratio combines a variety of fundamental technical sentiment indicators to imply what could be the price appreciation potential for the next several months.
Thanks, Sam. Steve, let me bring this question to you. We were talking specifically about sector-oriented ETFs, but some of the larger products that John Hancock has are diversified across various sectors. I'm thinking JHML, the large cap, and JHMM, which is the mid cap version, both U.S. equity focused. Can you just touch on how the sector diversification is set up in those? Do you favor certain sectors based on value and profitability characteristics, or is it equally diversified like you'd find within the S&P 500?
Yeah, so what's interesting about that question, Todd, is there isn't anything explicit that would lead us to overweighting or underweighting any sectors. In fact, as you think about the process that we described, starting at the market cap weight actually helps us stay similar to the benchmark. No doubt there are certain sectors over time at specific rebalances or through the course of the time from one rebalance to the other based on performance that a sector may have an overweight to, say, a benchmark like the Russell 1000 or the Russell mid cap, in those 2 examples, as a more kind of universal benchmark. But explicitly, all we're focused on in all of these portfolios, candidly, are focusing on value, size, and profitability and tilting the portfolio that way. Again, nothing explicit towards a specific sector. They end up actually being quite similar to the benchmark and not really a driver of returns for the most part.
Thanks, Steve. I'll bring another question to you because one of the listeners highlighted that CFRA has a 4-star recommendation on JHMD, which is the multi-factor developed international ETF. I assume that the underlying approach is the same. Anything you want to specifically talk about how that's different than some of the more cap-weighted strategies from other asset managers? Sure.
Yeah. I mean, I think, again, we're all the strategies have that foundation of value, size, and profitability. So yes, the indices are quite similar. Some of the unique elements is there's an element that's not too dissimilar to the sectors in that we do look at the stocks within a country specific. So that's great because you do get some weightings within the country, right? If you were to just weight, you may end up with a large overweight to one country or another country. So we really do focus on trying to make sure that the ETF itself doesn't fly too far away from the standard benchmarks. So that's one thing. And the other thing is again, we see that our JHMD is going to have that lower exposure to sort of the mid cap world or the lower cap world, even though it's considered a larger cap developed international fund. It's going to tilt towards the lower side of market cap, and we're going to be on the left hand side in the value and growth perspective. But what's nice is that the profitability is a ballast to that, so we don't end up with a portfolio that is way to the left hand side, if you will, in the value category, or way to the right hand side in the growth category. These products are really meant to fit into the core of a portfolio, and when I say the core, the middle section of your portfolio, and to sit there in a very to allow for you to get exposure to these premiums that over time have exhibited the ability to drive expected outperformance.
Thanks, Steve. And Sam, I'll do one last question here for you. We've had a nice bounce back in the last month or so. The market ended a few weeks, not ended, but the data was as of late March. How long has it typically taken to get back to break even when we're in the middle of a bear market?
Well, good question, Todd. That tends to be the $64,000 question that a lot of investors are asking. We ended up in this bear market eclipsing the 10% decline threshold faster than any bear market going back to World War II. Actually, we went into a bear market mode past the 20% decline threshold twice as quickly as we did in 1987. And then if indeed March 23rd is the low point, then we got to that low point in 33 calendar days, which is 3 times as fast as we bottomed out in 1987. So should we end up with a similar kind of recovery, I think investors would definitely be breathing a sigh of relief. But just to put things into perspective, the average time that it takes to get back to break even from a 20 to 40% bear market, what I call a garden variety bear market, is 14 months. So this time next year, we could easily be in new all-time high territory. And actually in 3 of the bear markets, back in 1966, 1980 to 82, and then the 1990 bear markets, got back to break even in 7 months, 3 months, 4 months, respectively. So we could, depending on how quickly the economy bounces back and how optimistic investors are by looking across the valley into 2021 earnings expectations, which right now are very strong, we could end up getting back to break even more quickly than the average garden variety bear market.
Thanks, Sam, and thanks, Steve, for your answers to those questions. Let's just move forward onto the slide deck. What you're seeing here is a list of the various John Hancock sector ETFs. We touched on JHML and JHMM, the large and mid cap, and JHMD, developed international. Here's the rest of the sector suite of products. On the next slide here, what you're seeing is the next webinar that CFRA will be hosting. It'll be in a couple of weeks. Some of our colleagues are going to be talking about this overall asset management industry and the trends we're seeing within wealth management. Our head of equity research and an analyst specifically focused on the asset management industry are going to talk about what's driving that, specifically how ETFs are playing a role in the underlying companies behind these ETFs and mutual funds, talking about private equity. It should be a great event. I'm going to be tuning in as well from my home, and I hope you registered. You can see the link on the bottom, and you'll receive an email inviting you to it. If you're not using MarketScope Advisor, which is where you can find the content from Sam, myself, our equity research team, we encourage you to go learn more about that at this link that you'll see on the bottom of the screen. On the next slide here is an opportunity for you to be able to get direct access to some of our content for free through May 31st. People who sign up will get 90 days of our Outlook publication, which is an online newsletter. This is geared towards individual investors, so advisors are more than welcome to pass this on as a reward to their clients or to be able to take a look at it themselves. This is not a sales pitch that I'm making. This is an opportunity during this unique environment to be able to stay up to date on what CFRA is thinking and keeping your clients informed with that. And so I'll move us to the next slide to thank you for participating, to thank Sam and for Steve for joining me during this webinar. Thank you for taking your time to spend with us. I hope you have a good rest of your day. And please, I think a survey is going to pop up. We'd love your feedback for how we're doing and what we should do for the next upcoming webinar. Thank you and have a wonderful day.